Hello, everyone. I want to welcome you to today's webinar, Hot Topics in Higher Education Retirement Plans. I'm Jeff Levy, Managing Partner at Cammack Retirement Group. I'm joined today by Tracy Manzi, Vice President of Investment Services, who will cover some of the issues with the integration of ESG and world bond asset classes in retirement programs today. Joey Payne, who's a Vice President and Senior Consultant, we'll cover some record-keeping fee approaches and small balance cash outs. And Mike Webb, a vice president in our firm, will discuss some retirement plan features impacted by COVID-19. If you have any questions, please enter them in the chat box on the right side of your screen, which we will address for you at the end of our prepared comments. A copy of the presentation is available on the right side of your screen in the handout section, and we will be offering or providing a recording within the next few days of the entire presentation. So without further delay, I'd like to turn it over to Mike Webb.
Thanks, Jeff. We thought we'd start things off today by reviewing some of the problems that universities have encountered during the COVID-19 pandemic, and a lot of them surprisingly stemmed from the design of their plan document. And one good thing, just to start us off, if you haven't read your plan document in a while, if you're a plan sponsor out there or one who's working with a plan sponsor out there, it's been too long if you can't remember the last time you read it. The number one problem we see on audits and in general in life as advisors is plan procedures, people operating the plan who fail to operate the plan in accordance with the plan terms, meaning they didn't know it was in the plan document, so they were doing something differently. So if you get one thing out of this, my section of this presentation today, go read that plan document. Yeah, you'll be surprised by what's in there sometimes. And one of the things that a lot of people were surprised about during COVID-19 was a lot of places have been strapped for cash, and legitimately so with all the issues that have been going on. And they're looking for ways to suspend contributions, possibly reduce contributions, or just change the approach a little bit to save expenses in the plan. And a lot of plan sponsors were actually shocked to find out that they had to go through a pretty elaborate amendment process and to reduce or suspend their contributions, and that even some people might have been entitled to a contribution this year because they put what's called a fixed formula in their plan as opposed to a discretionary formula in their plan. Discretionary means exactly that. You can do whatever you want every year. It doesn't matter. You could still do the same formula you have every year. For example, if you're doing 10% base now, for example, you, instead of it being a fixed formula in your plan document, merely say that it's discretionary, and all plan documents have that checkoff box or option to do discretionary or fixed. And it doesn't change your contribution at all. You can still say, hey everybody, I'm going to do 10% this year. I plan on doing 10% next year, but it gives you that flexibility so that if there is a crisis, you can turn the switch off right away. Because if you have a fixed formula in your plan, you can't generally turn the switch off right away, because at a minimum, you have to amend your plan to change the contribution amount. And of course, obviously, you have to go through whatever amendment procedures you have, and that can take some time, especially if you're desperate to raise some cash because things have happened, such as in a pandemic. So we generally recommend to plan sponsors that unless there's a compelling reason to have a fixed formula, to go with a discretionary formula. Now, yes, there are compelling reasons sometimes to have a fixed formula. Sometimes you're kind of stuck. For example, you public higher ed sponsors out there are probably well familiar with optional retirement plans. Basically, you're providing an optional retirement plan as an option to a state-defined benefit system. In those cases, the state statute a lot of times dictates what contribution formula is in the ORP. So you can't change it unless the statute's changed. So you're kind of stuck. But if you can, even if you can change it, there can be issues sometimes with having a discretionary contribution. For example, if you have a constituent group at your employer that might be in discussions to unionize, or there's a threat of unionization in general for that group. They might be more tempted to unionize if you had a discretionary formula, because technically you can change that at any time, rather than what they would call a guaranteed formula or fixed. To me, nothing is guaranteed in life and in retirement plans. So if you have a business reason to do it, by all means, do it. But I think a lot of plan sponsors, what they do is they simply check off the box in the adoption agreement, and they happen to check off the fixed box, and then they were surprised when a crisis came and they didn't have the flexibility to change the plan when they could. Another issue in retirement plans that's really been a pain during COVID-19 is this qualified joint and survivor annuity. Now, I could do a whole other webinar on QJSAs and QPSAs, but the bottom line is if you have one in your plan as a standard form of benefit, you have to get spousal consent on every loan and distribution that you do, for married participants, obviously. So that creates a huge problem in crisis times, because obviously during COVID-19, you didn't have ready access to go to a notary and do an in-person notarization. Now, the IRS eventually caught on to this and said, hey, electronic notarization is okay, but that took a while. And a lot of people got stuck in this pandemic needing money and having to wait weeks and even months in some cases in these plans that require spousal consent. And legally, spousal consent is not a requirement in the vast majority of 403B and 401k plans. There are plans called money purchase plans where you do have to have that requirement, but a lot of 403Bs and 401ks don't have that requirement. So you may say, well, why does everybody have it? Well, especially in higher ed, what's happened is that a lot of the annuity contracts have a QJSA requirement. For example, the largest plan provider here in the space has their old contracts have QJSA hardwired in. So for anybody who's in those contracts, guess what? You can't get out of it. So your plan has to have QJSA by default. But that's not all the plans out there. There's a lot of plans, particularly plans that aren't subject to ERISA, like public higher ed, that they've kind of gone along with having a QJSA as their standard form of benefit, and they don't have to. And by having it as in there, they've needlessly require spousal consent for all these loans and distributions when they don't need to. And not only is it an issue during a pandemic, it's just an efficiency issue. I mean, most 401k plans where almost no 401k plans have a QJSA as a standard form of benefit. In those plans, you can go in and just do a loan or a distribution electronically because you don't have any notarized consent requirements. So it's a process that's much more efficient. And unfortunately, in most 403 plans, it's exactly the opposite. We have this cumbersome process. So the takeaway here is go to your record keeper, see if you can get rid of your QJSA, because some 403 plans can. And by all means, I think you should do so. And that doesn't mean you can't have annuities in your plan that participants can elect. It's just not going to be the standard form of benefit in your plan. Because again, forget about the administrative issues. It's almost impossible to explain this benefit to a participant. So the last thing I wanted to talk about in my portion, before I pass it over to Tracy Nancy, is loan offsets. Now, this is more common in 401k plans and corporate plans, but there are some 403 plans that have this, so I thought it was worth mentioning. Another big issue in the pandemic was a lot of people got laid off. Well, in the corporate world, if they got laid off, they kind of had double whammy with their retirement plan. If they happen to have a loan in their retirement plan and they got laid off, they have to pay it off all at once. Like, the IRS has relaxed the rules about this. You usually have to pay it like by the filing deadline of your tax return for the year, but still, it's not a lot of time if you're having to come up with $10,000, $20,000 and you're out of work. So fortunately, a lot of 403B plans allow loans to continue to be repaid after termination of employment. In fact, a lot of 403B plans allow even terminated employees to borrow. But if your plan, for whatever reason, is not one of those plans and there is an offset at employment termination, I would strongly consider, again, no big advantage to me to keep terminated employees from paying off their loans. Some plans only have loans by payroll deduction, so that could be a problem, but payroll deduction is kind of problematic nowadays too, especially with people on leaves of absence. So I would say not to have that feature if you can possibly avoid it as well. So I hope that's been helpful. We gave you some tips and tricks. I'm going to pass it over to Tracy now, who's going to talk about some investment hot topics.
Great, thank you, Mike. So two interesting topics that we find ourselves talking a lot with clients today are world bonds and ESG investments. So for those of you that don't know, world bonds are sometimes used as a complementary fixed income asset class in a retirement plan. And in fact, a lot of them are found in target date funds as well. Mike, if you just turn it forward to the next page, that would be great. The case for adding world bond into a retirement plan is that it provides diversification and the chance to take advantage of a greater opportunity set. When you look at the chart on the left-hand side of the page, you can see how the world markets have evolved over the last 30 years or so. And you can see that the US used to represent the lion's share, or nearly 60% of the total fixed income universe. But as developed and developing markets have had greater financial access to the markets these years and have grown tremendously, the US now only represents 1/3 of the total fixed income universe. So from a purely representative standpoint, it hasn't made sense to ignore 2/3 of that marketplace. The trend is also mirrored when you look on the chart on the right-hand side of the page with the explosive growth that we've seen in the corporate bond market. So turn ahead to the next page, Mike. These trends has really led us to add world bonds into our client lineups over the last couple of years. But when you see some changes that we're seeing in the fixed income marketplace, that's really started to slow down. You may have heard a lot about what's been going on in the press these days is the negative interest rate environment. So what we've seen is that the economic recovery has stalled in the biggest developed markets, predominantly continental Europe and Japan, over the last few years. These central banks have pushed their interest rates below zero in an effort to revive their economies. While the rates are still positive in the US, the dramatic decline in bond yields has pushed yields through zero in many parts of the world. And today, when you look across the fixed income marketplace, there's nearly $15 trillion of bonds that are trading with yields below zero. That equates to approximately 30% of the bond market. Well, the data on the right-hand side of the page takes a look at some select yields across the developed bond markets right now. And I kind of refer to this as a heat map. When you look across the different yield curves, what you see is anything that's deep in red is deeply in negative territory. Anything that's pink is moving closer to negative territory. And shades of green really show the only bond markets that have positive yield at this stage of the game. You know, this trend is really not exclusive just to the government bond markets. We've even seen over the last couple of years some corporate bonds trade with negative bond yields too. So from an asset allocation perspective, it's really hard to make a case for actively adding world bonds into a retirement lineup, particularly when you think about you're going to get paid less money at maturity. That basically means that it's not serving as a capital preservation asset. We don't think that this makes a lot of sense right now, so we've been actively advising our clients, if they're streamlining their menus right now, not to add world bonds as a complementary fixed income asset class. And we're also having conversations with our clients about the changes in the fixed income landscape who currently have world bonds as a category. Another hot topic for DC plans right now is ESG investments, or what we call socially responsible investments. Before we dive into some of the topics, let's just take a look at what ESG investing is. ESG simply stands for environmental, social, and governance. Some of the environmental criteria that's typically assessed ranges from natural resource to waste management, climate change, certainly a hot topic these days, as well as clean energy. Some of the social criteria that they take a look at are human rights, gender diversity, social opportunities, community engagement, product responsibility. And governance issues typically range around things such as business ethics, corporate governance, and corporate behavior. A lot of investment managers are using these criteria to help them make better decisions in assessing the future financial performance of companies, both in terms of risk and return. So next page, Mike. Well, ESG tends to get lumped together in one catch-all phrase. There are actually different approaches that are being used by managers. Some managers use what we refer to as negative screens, which basically means they'll construct portfolios that excludes certain types of activities such as weapons, nuclear, tobacco, and even environmental damage, or such as fossil fuels. Other managers use positive screens where they don't necessarily exclude these factors with the negative screens, but they look for leaders within the sectors who are doing the right things in their respective sectors. Right now, the most commonly used approach is what the marketplace refers to as ESG and integration. All this means is that ESG criteria are used in conjunction with the traditional fundamental analysis when analysts are making valuation analysis for companies or deciding whether they should make an investment. The two other approaches that are commonly seen in ESG are what we refer to as thematic investing or impact investing, where the managers have a specified goal which is specifically beneficial to the society or the environment. And it's sometimes questionable if making a financial return is the primary objective. Some interesting tidbits about ESG as it relates to defined contribution plans on the next page. According to some of the studies that we look at, right now, 18% of plans currently offer a socially responsible fund. I suspect that's a little higher among our client population. 64% of millennials feel that ESG issues are important. However, far fewer amount are actually investing in ESG when we look at the data. And 37% of participants are expressing an interest in ESG. These trends that we're seeing in the marketplace certainly correspond with the explosive growth that we've seen in ESG and ESG-related products in recent years. In fact, just last month, the DOL issued an update to their guidance on ESG investing in retirement plans, basically reiterating that plan fiduciaries cannot sacrifice returns or take additional risk when selecting an investment, stressing that economic returns must be the primary consideration for whether or not to include a fund in the lineup. Prior guidance suggested that ESG factors could be considered as a tiebreaker when considering two investments similar in performance and in cost. This means that addressing a social or environmental criteria cannot be the primary objective. Maximizing returns should be paramount in the minds of plan fiduciaries. Well, the commentary period on this proposed ruling by the DOL is still ongoing. It's definitely an issue that we'll be looking at closely in the coming weeks and months so that we can continue to advise our clients. Thanks. And now I'll turn it over to Joey.
Okay, thanks, Tracy. My topic today is record-keeping fees. And so when we talk about record-keeping fees, this is the monies that are earmarked to pay for the plan administrative type activities that the vendors perform for your retirement plans. So these fees are typically collected through the net expense ratio of each investment that's in the plan. At a high level, there's two ways these funds are collected. In a bundled arrangement, this is where the record keeper gets the desired revenue through the investment menu that they establish. So in a bundled arrangement, the record keeper is going to select the funds that are being used in the plan, and they're also going to select the level of fees or share class that are being used in the plan as well. And I have a slide in a few minutes I'll show you that illustrates that. So in an unbundled arrangement, this is where the plan sponsor actually negotiates a required fee for the record keeping or plan administration on the plan. And so with the unbundled arrangement, the plan sponsor has the ability to determine what level of fees that are being charged in the plan. The record keeping fee could be paid as a flat fee to the vendor, or it could be negotiated as a percentage of assets, sometimes referred to as basis points. Next slide, Mike. Oh, before we leave there, the last bullet I want to mention is in the unbundled arrangement, if you're working with an insurance company, they typically require that you move away from their annuity products to a open architecture mutual fund platform before you can negotiate a set fee just for plan administration, and the employer have the ability to establish the funds in the lineup. So next slide now, Mike. Thank you. So when we talk about flat fees versus basis points, the benefits of moving to a flat fee is it's easy to understand. everybody pays the same amount. This is very popular in the 401k world. The downside is the flat fee tends to be a higher percentage for people with lower account balances versus people that have higher account balances. So in the chart you see on the right, if you had a flat fee of $80, this would be an annual fee. So you would actually divide that by 4 and they would pay $20 at the end of each quarter. When you divide that by $10,000, it's 0.8% on a $10,000 account balance, whereas that $80 on a $250,000 account balance is only 0.04. Now, in contrast, if you're paying a percentage, in this example, it's 0.08% or 8 basis points. The person with the lower account balance only pays $8 in that first year, whereas the person with the higher account balance is going to be paying $200. So, you know, that's probably the biggest reason that we see people not moving swiftly into the flat fee, is realizing that people with lower account balances end up paying more as a percentage. And then at the bottom of the slide, there's a note that since this is very prevalent in the 401k world and moving into the 403b university space, the record keepers are looking at different variations of how fees can be charged. You know, where sometimes you could charge a percentage up to a certain point, and then there's a flat dollar max that's applied. But in those particular cases, if you're going to charge people less that have higher account balances, the people that are on the bottom are still going to end up paying more. Next slide, please. So when does moving to a flat fee not work? It really has to do with the big example I can give you is when you're changing record keepers. You know, if you're with a current record keeper in annuity products, you know, you've got fees that you're paying there that can't be mapped over if they're individual contracts to the new vendor. And so the person is paying, you know, the fees for the old assets. And then you go to your new record keeper, and in year one, in the top chart, if they contribute $15,000 in that first year, if the fee is 8 basis points or 0.08%, they only pay $12 for the new money, and you combine that with the old money. In this example, it's $132. But if that person has to pay a flat fee on those new dollars down in the chart below, that's $80 on the $15,000 balance, coupled with the fees you're paying with the old record keeper, they end up paying more money. So where flat fees do work is if you're in a mutual fund environment where all the funds are liquid and can be mapped to a new vendor, then you have leverage to not only negotiate lower fees, but the fees are more equitable because everybody is paying that fee and you don't have the legacy assets that are being left behind where people tend to be paying higher fees. Next slide, please. So fee levelization. So what does it mean to levelize fees? So to levelize fees, it means that each fund, regardless of what you're in, would be charged the same percentage if you're in a basis points environment for record keeping, or if you're in a flat fee, then the flat fee takes care of that, and any kind of embedded fees would be returned to the participants that have those funds. So the record keeping fees are paid through the net expense ratio of the investment. Some funds have built-in revenue share to pay for record keeping fees. TIAA annuities, TIAA refers to it as a planned services expense offset. And so those are monies that are earmarked to pay for revenue share towards record keeping. And then actively managed mutual funds can have monies that are built in for revenue share, depending on which share class is being used. And I have a slide I'll show you in a few minutes that illustrates that. And then finally, a lot of index funds that are added to plans don't typically include revenue share. So why should plan sponsors levelize fees? Well, the biggest issue is fairness, and it ensures everybody's going to pay something for plan administration. So if you go back to the last point that I mentioned, that some index funds, people that are in those funds are not paying any record keeping fees. And so what we've seen with plan sponsors, TIAA, for example, when we've approached a new client with an all TIAA fund, oftentimes you'll see that you have the legacy annuities that are being used, but you also have mutual funds. Sometimes the mutual funds are at a premier or an institutional share class, but oftentimes they're at an institutional share class with no revenue share. And certainly we see the index funds at no revenue share. And as these funds have been added to the lineup, a lot of times what's been communicated to the plan sponsor is we have enough money to cover the required revenue in the plan. So you're able to offer these funds to the individuals, at the lowest cost possible. Well, on the surface, it sounds like a good thing, but what we see and hear anecdotally when we do presentations is that some employees are selecting to just go into the index funds, and therefore they're not paying anything for record keeping. So in order to, if you charge a percentage across each investment that's typically done on a quarterly basis at the end of the quarter, it ensures everybody is paying something. And then those people invested in funds that have that built-in money for revenue share oftentimes get a credit back on the excess money that is in that fund for record keeping. The other item mentioned here on the slide is just giving plan sponsors more control of the monies that are going to the record keepers. The last bullet on the bottom of the slide, the monies going to record keepers is one of the hot topics that, items being cited in higher ed lawsuits that we see. And, by going to a flat record keeping fee, it does, limit the amount of money that goes to the record keeper. Once you get to a flat fee, then it's all about, well, how much is that flat fee? But if you stay on a percentage basis, or, then you can, first thing is to negotiate a required revenue so that any revenue that is generated by the plan beyond the required amount goes into a revenue credit account that can be used for plan expenses. And then any excess money after plan expenses have been paid typically is returned back to the participants. On the next slide, there's an illustration of how, if you stay on a percentage basis, that you could potentially cap how much money is going to the record keeper. So in this example, you have a $300 million plan at 8 basis points, so you would expect $240,000 a year going to the vendor for record keeping fees. Now, there's a lot of variables that come into play, such as number of participants, average account balance, etc. But holding those things equal, you could build in an inflationary increase for the record keeper versus just having them get market increases that sometimes can, be 10% or more in a given year. Next slide, please. So here's an example of fee levelization where we're looking at, in this case, share class. In the first two rows, you'll see the craft stock and TIAA real estate. In the middle of the slide, plan services offset, it just shows you how much money is being set aside for plan administration record keeping expenses. And then in the rows below those, you'll see the TIAA Lifecycle Index. You have the 2030 fund offered in 2 different share classes, Premier and Institutional. So you'll notice in the first column there, the Premier share class at 0.25 or 25 basis points is higher than Institutional. So the participant is paying more. But if you move over to the middle column, you'll see there's 15 basis points that is available for revenue share. So we think, utilizing the institutional share class, or in other mutual funds sometimes referred to as an R6 share class, using the funds with 0 revenue share is the best option. And then building in a quarterly record keeping fee and that gets charged by the record keeper to participant accounts on a quarterly basis, and then returning any built-in revenue share either to a central revenue credit account or directly back to participants is the best way to go. And that would be in addition to taking a look at a flat fee if that's appropriate. And then finally, on the bottom of the slide, as I indicated earlier, right now, if you're in a bundled arrangement, oftentimes the vendors, not always the case, but oftentimes they're using a share class that's not the cheapest. In this example, American Funds Growth Fund of America R4 share class, you can see that it's 0.66% at that level. That's what the participant pays. But if you move from left to right, you'll see there's a 12B1 fee, which is a commission and a sub-transfer fee, a transfer agent fee of 0.14. So there's 39 basis points total that's going to the record keeper, whereas American Funds is getting the net investment fee of 0.27. So the alternative is in the R6 share class, you know, the participant is paying 0.31 or 31 basis points. There's no 12B1 fees involved in this particular fund. There is 4 basis points going towards record keeping. Depending on the size of your plan, that's probably not enough to cover your record keeping fees. So you would still have to add monies on a quarterly basis to cover your record keeping fees. But it's certainly going to be less for your participants versus paying the higher fee. Next slide, please. And you know, if you start stripping away the revenue that's in the plan, you still have to fund your revenue credit account. Most of our clients pay their legal, audit, and consulting fees through the revenue credit account. And so where the funds that are in the plan initially determine the excess revenue, if you go to a fee levelization model, then what you have to do is actually build in an amount to fund your revenue credit account. So in this particular case, the plan requires 8 basis points for required revenue, and the plan determines it needs 3 basis points to fund a revenue credit account. So you add those two together, and then that's applied on a fund-by-fund basis. And you notice at the bottom, the mutual funds at the R6 share class, there's no built-in revenue share. So they simply, in this example, get charged 11 basis points at the end of each quarter for record-keeping fees. Next slide, please. So the final topic we're going to talk about is small balance cash out, sometimes called automatic rollovers. So a small balance cash out, this is where when you have employees leave your institution, their record keeper is notified, and if you have checked off this provision in your plan, if the record keeper sees that they have less than $5,000 in the plan, then they're going to generate a letter to them that indicates that their money is being rolled out of the plan to a selected IRA provider. And they're given a letter and ample notice so that if they have their own IRA or they want to transfer the money somewhere else, they have the ability to do that. So the advantages of having this is if you can eliminate the participants that have low account balances, you can actually increase your average account balance, which is going to lower your record keeping fee. Average account balance is a key determinator of what your record keeping fees are going to be. And if you just think about it, in this example, you know, we have started out with 3,000 participants, and we determined 1,000 of them have assets less than 5,000. Let's say they average $2,000. Well, that's $2 million. So if you can get rid of 1,000 people who don't work for you anymore, and you're only giving up $2 million in this example, dividing 2,000 into 298 million is going to give you an average account balance of 149,000. So that's just fewer people the record keeper has to deal with, you know, as it relates to statements, notices, customer service calls, etc. And it's really better for everybody. And even the person that's leaving over their career, if they can start consolidating their retirement plans into an IRA or roll them to their new employer, then they're able to keep track of their investments over time. And, as you go to implement the small balance cash out feature, you're going to have to update all your plan documents to make sure you select that. You're going to need to select an IRA provider. I know a lot of public universities kind of cringe. They're like, oh no, that's another RFP. And in some cases it is, but we've actually had clients when they talk to the procurement office and they indicate that typically the record keeper that you use, they have a contract with a national IRA provider. And in that contract, they that contract can be extended to the clients of that vendor. And so what you're typically suggesting is you're just tapping into a downstream vendor contract. And one of the big items university procurement offices want to look at is university money. In this case, there's no university money involved. And that tends to go a long way in this situation. And so the only money involved, typically these IRA fees are around $30 a year that the participants have to pay. And so, it's not a huge amount. So it helps the plan become more efficient. And it also helps the individual get on a right track of consolidating their retirement assets over time. So I think that's the end, Mike, to our presentation today. And at this point, we want to open the floor for questions. So I guess, Jeff, you'll facilitate the questions.
Sure. And I'll remind everybody there's a chat box on the right side of the screen. If you can enter any questions you have there into that chat box, we'll be happy to address them. We do have some to kick us off. And the first one is to Mike. Mike, part of your presentation, you indicated that a loan offset can be treated as a coronavirus-related distribution. And the question is an ordinary loan default a coronavirus-related distribution as well?
Unfortunately, the answer is no, it is not. Very good question, by the way. But it probably doesn't matter so much if you think about 2020, because what's going on is the bigger risk you have is someone having a loan offset, which is an actual distribution when they leave, and the plan doesn't allow continuation of loan repayments. If you're allowing continuation of loan repayments, even for that termed employee, never mind for active, and an employee gets behind on their payments, or a term employee gets behind on their payments, remember in 2020 we can delay those payments. Basically, an employee has a free pass on loan repayments until January, unless you didn't adopt that provision in your plan. But the CARES Act allows you to do that. So even though, yeah, that would be if someone defaults, either active or term, on their loan, that's a pretty terrible circumstance, because it is treated as a deemed distribution or taxable event, but you actually can't use the favorable coronavirus tax treatment. So that's pretty bad. But the reality is I'm not expecting a lot of loans to actually be defaulted on in 2020 because of this payment holiday that people had basically from, I believe, from March until December. So good question, but I think the roads lead to the same place. The advice would still be the same, to not have the loan offset, even though obviously if someone's terminated and they're allowed to continue loan repayments, it could indeed result in a default. But for the terminated employee, that's an actual distribution. So you only have to worry about loan defaults for active employees being a distribution that's not coronavirus related, and that would be tough. But again, not expecting to see those in 2020 because of the CARES Act basically allowing loan payments to be delayed.
Thanks, Mike. The next question is for Tracy. Tracy, do you think the ESG debate will become moot someday because most every fund manager will ultimately incorporate at least some ESG principles into the management of their funds?
That's a good question, Jeff. I don't think that it'll become moot someday. As I mentioned, ESG is basically a catch-all criteria for looking at those various different factors, and those factors that they look at are going to always differ from manager to manager, sector to sector, how much weight they place upon them. But as I mentioned earlier, there's various approaches that managers do use, from the negative screening, positive screening, and even the thematic and impact investing, where managers are looking at single theme or multi-theme strategies in order to create a specific good. So as long as there's demand for various different needs to address this, I think that the marketplace will continue to create products to address that demand. And I don't think it's going away, even though more managers are using and incorporating ESG into their fundamental analysis.
Okay, great. Thanks, Tracy. Joey, the next one's for you. We've noticed that a lot of our peer universities have yet to put in a flat fee arrangement, despite the fact that it appears to be a good idea given the recent litigation. So the question is, have the large record keepers in higher ed had significant experience in administering per head charges, or should the plan sponsor be concerned that they'd be ahead of the curve and thus risk having a poor implementation experience with the vendor if they try that approach?
Well, that's a good question. Certainly those that are play heavily in the 401k space have ample experience administering a flat fee, because that's predominant in that market. So though if you're working with a vendor that is not typical, work in the 401k space, then I think that's a very good question. And one of the things you have to ask about is, how fees that are in, if you have multiple contracts, legacy contracts, new contracts, and you have a flat fee in a new contract, how fees are handled in the old contracts. So, but that's something that you can work with your consultant to determine what that record keeper's experience has been when you're contemplating adding a flat fee to your plan.
Great, thanks, Joey. Actually, another question for you. So one of the participant or our audience has multiple record keepers. And the question is, if a terminated participant has $3,000 with vendor X and $3,000 with vendor Y, can his or her balance be automatically cashed out? Or since it's over $6,000 in total, is there a restriction that it cannot be cashed out?
Yeah, in that example, it couldn't be, because the plan limit is $5,000. So even though you have $3,000 with two different record keepers, you still have $6,000 in the plan. And so doing the small balance cash out is a slam dunk if you're in a single record keeper environment. The more record keepers you have, that's added complexity. It doesn't mean that it can't be done, but it might be more like a project once a year. Over the summer, you may say, we're going to take a look at all the people that separated employment the past year, and we're going to get account balances from each of our record keepers. Now, some common remitter systems, can pull that data for you as long as the record keeper is reporting data to that system. But sometimes you have legacy vendors that are not a part of the active plan. So looking in your HRIS system to be able to see, who people's legacy vendors may have been. So, as this may sound, it could be pretty entailed if you have, multiple record keepers. So much easily accomplished in a single record keeper environment, doable in a multi-record keeper if it's a smaller number, or if the common remitter has the capability of reporting plan balances on each participant.
Okay, yeah, great, Joey, appreciate it. We still have plenty of time for more questions, and I think Kara has told everyone that we'll be happy to answer more online today, or you can submit a question and we'll be happy to get back to you. I'll remind you also that the presentation is in the handouts section on the right side of your screen. You can download it right there. Any other questions from anybody in the audience? Okay, well, since we do not have any other prepared questions now, I want to thank the panelists for their comments, and we look forward to getting any other questions from the audience in the next few days. And we will be sending out a copy of a recording of the presentation, again, in the next few days. Thank you very much. Since we have no other questions, we will conclude the